I think the main question continues to be, what is the reaction function? And I think that ambiguity about the reaction function has been the challenge that most have had in the markets, over the course of the last really year or so. What it looks like, based upon the statement, is that the emphasis is going to be around those financial market risks, much more so than the risks that every day the inflation remains elevated, there's an increasing risk that it becomes entrenched. And to be clear, that's very normal. Early in a longer term inflationary cycle, most central bankers are typically quite hesitant to meaningfully tighten in the face of inflation, of elevated inflation pressures, because the risks of tightening too much are relatively known and concerning, and the risk of not tightening enough are basically things that play out for an extended period of time. But odds are, if the Fed continues to take this extremely cautious path, and inflation continues to be elevated over time, and we continue to have it seep in and get more entrenched in the economy, the bigger mistake the Fed will be thought of as making during this period is not getting started too late, but it's going to be much more about the fact that they stopped hiking too early. And that's the real risk for the Fed, that they'll have to do a whole heck of a lot more a year from now, let's say, because they've been too hesitant today because they're concerned about financial risks.
Bob, I gotta tell you, it feels like you're in the minority here, given, at least compared with most of the folks we talk to, right? Most of the people we talk to warn more of a policy mistake here from over-tightening. Breaking something in the system is something we've heard from the likes of Mohamed El-Erian and others. I think Greg is probably somewhat on the same page here, that we saw a little hint of it, right, with the regional banking crisis, but it didn't blossom into something more. Aren't you worried about that kind of a risk as well?
I think the question from the Fed's perspective, which is what they're trying to do, what their mandate is to preserve the highest quality medium-term growth by balancing both employment and price stability. And when it comes to the thing that determines medium-term growth is productivity, and the thing that determines productivity is price stability more than pretty much anything. And so I think there are a lot of people out here talking based upon their life experience of a secular disinflationary environment where we're being responsive to growth was the prudent strategy because there was no cost to not being responsive to inflationary pressures. They didn't have to worry about inflation. But we're in a different environment. The world of 40 years of secular disinflation is over. We're moving in the opposite direction. And what we're seeing is, across both the Treasury and the Fed, a set of dovish responses that, if continued, will put us on a path to a longer-term, higher inflationary environment. And so it's true, we've got to call up experiences like that of the 60s, where we had expansionary deficits and monetary policy that was too easy, that set the stage for the inflationary 70s. Those are the experiences that are most pertinent, not people's experiences and views drawn from decades of disinflation and peace.